Okay, welcome back. This is our final panel. It's on funding trends in 2022. Everything you ever wanted to know about funding, but were afraid to ask. Today we're going to talk about some things that are going on in the funding industry, and we're going to segue into things that a borrower needs to know before they enter into a debt relationship. So as we get started, I'm going to throw my first question out to Jeff. But Jeff, before we do that, why don't you introduce yourself?
Sure. Thank you for having me. Appreciate the opportunity. My name is Jeff Mitchell. I'm Executive Vice President for Woodforce National Bank. My office is out of Tampa, and we are about a $10 billion bank based in the Woodlands, Texas, just out of Houston, Texas. And we are a full-service commercial bank focused on middle market and corporate lending. So to answer the question as far as interest rates, does it make it more difficult to qualify for a loan when the interest rates are increasing? I would say not necessarily, but anybody that's underwriting a loan is certainly going to be doing some interest rate testing and some stress testing to anticipate the future increases, just to see what impact, if any, that has on the gross profit margins of a company. So at the end of the day, banks and many financial institutions are underwriting the net income and the EBITDA and determining what sort of timeline it takes for a loan to be repaid, and certainly higher interest rates contract that ability.
Sure, and I can tell you as an asset-based lender, I'm going to look at things like the debt service ratio, see what impact the interest rates have on the profitability of the company and of course their ability to service debt with the higher interest rates. Jeff, do you think that what's going on, kind of in the housing market where when there's a concern that interest rates are going up, there's a big rush to buy houses? Do you think with what's going on now, it's going to cause a rush toward people trying to get financed before rates go up higher?
Most of the rates that we do, are on a floating basis. So, certainly, anybody looking to finance an asset or make an acquisition of another company, they're going to be sensitive to that and certainly anticipating what the increases would do to their ability to repay in the future. Sure. But to the extent there's some fixed pricing, and there still is some fixed on shorter term deals, that's absolutely true.
Yep, great. Let's shift gears a little bit. We're going to bring Jason Medley into the conversation. Jason, first off, welcome. Thank you for joining us.
Thank you for having me.
Sure. Why don't you give our audience a little introduction of who you are and what you do, Jason?
Certainly. I am a finance attorney, commercial finance attorney, based here in Houston, with offices coast to coast, represent lenders, much like those who are on the panel here. I've worked with a few of them as well, and have been doing it for about 23 years, and have seen a lot over that period of time. So happy to share some of the war stories and some other things that maybe some of the borrowers and companies that are attending today might be afraid to ask.
Great. So I'm going to start off this. I'm going to throw this next question out to the panel, and I'll start off with you, Jason. From a legal perspective, what can a proposed borrower do to make themselves more attractive to the lender? And to make the process run more smoothly?
You bet. So from our perspective as the attorneys doing deals, when they come to us and they've already gone through credit committee or they're about to go through credit committee, what we see making the process more smooth and faster, and therefore better for the proposed borrower, is that they have their house in order from a corporate governance standpoint. Even though companies might be profitable with lots of cash flow and goods coming in and out, and business is running on all cylinders, it's not surprising to see even companies like that, established companies, that are perhaps not in good standing with either the Secretary of State or the state comptroller for something as simple as just not filing an annual report. And it's easy to check those things and verify them either through your legal counsel or yourself. You can go online and do that. You can run a lien search against yourself and see if there's a lien that you didn't know about or that should have been released a long time ago. You want to have your corporate governance documents like your bylaws or the company agreement or the partnership agreement up to date and current. If you've got annual minutes or some kind of incumbency certificate that you do that shows who the current officers are, to make sure that's all up to date and consistent. That really goes a long way to letting the potential lender know that you're taking care of business and that you're haven't let things lapse. And not only does it look good to the prospective lender, but it'll help the process go a lot faster. You won't have to worry about spending time to get with the CPA to get back in good standing with the state to pay state taxes or franchise taxes, things of that nature. I think that's probably one of the best pieces of advice, and also the simplest really to implement.
Great. Thanks, Jason. Hey, Jeff, you want to add anything to that from the lender side?
Just it all starts with whatever the request is.
Mm-hmm.
So whenever, we have to understand what the ask is. So if they're looking to refinance debt, or if they're looking for, debt to facilitate the acquisition of another company, then, what dictates our laundry list of items is the specific transaction. But in terms of getting a package together, typically we're looking at the last 3 years of year-end financial statements, year-to-date financial statements. We like a comparative for the prior year. We generally want the agings of receivables and payables, inventory listing, a debt service schedule. It's a pretty robust list. More often than not, we also want to know organizationally what the company looks like, not only from a personnel standpoint, but a corporate ownership standpoint. We fund a lot of private equity and family office deals where there may be a holding company and several entities underneath.
Sure.
So ultimately, we need to drill down on specifically what that corporate org chart looks like, and the beneficial owners that the revenues and profits ultimately stream up to.
Sure. And the only thing I'll add to that is, again, as an asset-based lender, we look for a lot of the things that you would look at. Probably don't go as far back as the commercial bank would go. We're probably okay with a year or two. But I will say this about that whenever I send a data request to a prospect, they contacted us, we've executed an NDA, I send them a data request. When I get that data back in 1 or 2 days as opposed to a week or two, that guy moves to the top of my list, because one, I know he's motivated, and two, I know that he or she is, they got their act together. They've got their stuff ready to show, and that goes a long way. That's who I want to work on. So, my advice in that regard would be, before you even start trying to get any kind of funding, have your house, so to speak, in order. Let's move on to the next question, and I'll throw this out to Jason again. Jason, from a legal standpoint, what is the difference between factoring and traditional lending, and how does it affect a borrower?
So there are a number of different finance products that are out there. And certainly for companies that might not be traditionally bankable, that, don't give up, right? Walking in and getting a term loan secured by real estate or cash collateral in a CD is certainly going to get you more flexibility and get you a good rate. But there are other products out there. The asset-based loans that you described, where the lender will give an advance of money based on a percentage of eligible account receivables. And that's just a recurring loan every month. You give the bank a list of your invoices and some paperwork to certify that they are eligible, that they're attractive to the lender, and the lender will give you X% of money based on those account receivables. And that's just a traditional loan, a revolving line of credit. With factoring, factoring is a very old form of finance, but it's not a loan. It's a true sale of your account receivables. And so when you're giving the invoice information to the bank or the factoring company, they're actually buying those receivables at a discount. And so if you sell a $100 invoice to a factoring company and they gave you $80 or $90 for it, you've got instant cash and on day one, as opposed to waiting for your customers to pay you in 60, 90, 120 days, or if ever. And then you can just deploy that capital again and recycle and sell new invoices. Probably one of the biggest differences from the what I'll call the borrower's perspective. In a factoring deal, you're a seller, not a borrower. But for purposes of this discussion, we'll just call them borrowers. The biggest distinction is that in an asset-based loan, you're still in control of the invoices. You're still in control of your collection of those invoices. Now, they're probably going to be lockboxed into the bank or to the lender, but you're still more in control. You still own them. They're still on your balance sheet. They're still your property. But you're going to have a lot of loan covenants. The debt service coverage ratio, the fixed charge coverage ratio, things like that are going to potentially be defaults under the loan, or just be things that you're going to have to manage from a financial metrics standpoint. In factoring, you typically aren't going to see those types of covenants. The factoring company is going to care more about underwriting the value of your customers, the account debtors, the ones who are going to be paying the invoices that you just sold to them. I guess the flip side of that is that you've sold your invoices, and so now they belong to the factoring company, who will have responsibility for receiving them and collecting them. So those are probably the two biggest distinctions from what I'll call the borrower's perspective. It's very important for companies that engage in either one of those financial products to understand that, because it helps manage expectations, especially with respect to interfacing with the customers and collecting invoices and the flow of funds and the control of the cash.
Gotcha. Very good. Jeff, is there anything you want to add to that? I know you're really familiar with factoring and everything else.
Yes, I've throughout my career, I've been both on the bank and the non-bank side, and Jason's exactly right. I think what determines where a borrower actually fits really is the strength of the balance sheet. The stronger the balance sheet, the lower leverage, the historical cash flows. That's going to determine whether they would qualify for a traditional bank line of credit in this case, or if it's got to be more heavily weighted towards just the receivables, on the balance sheet. And Jason's right. There's depending on, again, the strength of the balance sheet, they'll either have a line of credit, structured asset-based loan against the receivables and sometimes the inventory. But to the extent factoring is the better route, then the real underwriting becomes, what do you sell, who do you sell it to, and are those customers credit worthy? And to Jason's point, rather than wait the 30 to 60 days to get paid, you sell it for 80 or 90%, you get your cash today, and then when the invoice ultimately pays, the factor balances back the remaining amount less the fees.
Perfect. As a factor, I don't think I could have summed that up any better. I'm going to ask a general question. I'm going to ask it in two parts, and I'm going to start with you, Jeff. What do you think companies can expect from capital funding sources, in 2023 and going into in 2022 and going into 2023?
I think, on my side of the equation from a bank standpoint, we're certainly, scrutinizing the leverage of all the balance sheets out there that we're looking at deals for. I would expect that, just to set the expectation, when you do meet with a bank or a non-bank to discuss financing, make sure that you're in a position to articulate exactly what your need is, what you plan to use the capital for, and have the information I mentioned earlier, your financial statements and some of the supporting documentation available so they can review it, but more importantly, speak to the future. How do you expect as a business to navigate the various headwinds that we're currently experiencing with higher interest rates, supply chain, inflation? There's just a lot of dynamics in the market that will have some sort of ripple effect on your business. Be prepared to discuss that and help them understand your business better through that.
Right. And to that point, what are some of the underwriting challenges that you expect through 2022 and 2023?
I think with the rising interest rates and the disruption in the supply chain, two things. We're scrutinizing what impact those higher interest rates would have on the gross margins of that business. Mm-hmm. And do our borrowers have the ability to, pass on some of those increased costs to their customers? And if they're not, then certainly it's going to be an added cost to the P&L. So that's probably the biggest thing.
Great. Jason, let me ask you a question. As you go through and look at some of these deals that have happened in the past, what are some of the common mistakes a borrower has made during a lending relationship, and how could they have been avoided?
Sure. Well, aside from the obvious of non-payment, but in the situations where you have payment default, when I see borrowers that when they can't give money, they should be giving information. And cutting off communication or avoiding communication is probably one of the biggest snafus that I see. It changes the tenor and the tone of how the lender relates back to me as the attorney, and I see a big difference when the borrower is open and transparent with communication, even in the face of particular defaults. I see a lot of companies that will go into covenant default because they just can't comply with the financial requirements, or they fail to meet the financial reporting requirements. And I think that comes from a lack of just having good help. You need a good solid bookkeeper, a good solid CFO, and if you don't have those people, you need to engage in finding them quickly. Because that can mean the difference between being in a technical default of your loan and not being able to access that capital, or having a good relationship and still being able to work through things, even if you're having trouble financially. Being open and transparent will just make all the difference. In the factoring world, probably the biggest mistake that I see that kind of sours the relationship is when, you sell an invoice to a factor, and then the customer that's paying the invoice is supposed to be paying the factor, but instead accidentally sends the money to you, the factoring customer, the borrower, and you either don't notice, or you just the money is kept, kind of a misdirection of the proceeds. That is certain to sour a relationship quickly. And so keeping your eye on the cash flow is very important when you're in a factoring relationship, and making sure that the money is going to the factor, because you already got the money for the invoice when you sold it to them. And probably also one of the biggest things I see on the front end is when a prospective borrower, gets a term sheet or a letter of intent, and then doesn't read it. That term sheet is extremely important. It lays out the high level, parameters and terms of the deal. And then those terms get put into the actual loan documents. So it's very important for prospective borrowers to read that. That's the time when you want to negotiate things. That's the time when you want to clarify things or any misunderstandings, because that's what the lender is then going to use as the green light to go and create documents and generate the loan documents. And so I think it's, very important for prospective borrowers to pay attention to that part of the process.
Sure. Okay. Jeff, anything you want to add there?
No, just to kind of echo what you were just saying there, Jason. I think having, certainly your personnel, strong controller, strong bookkeeper, to interface with that factor, with that finance company. You're exactly right. When we lend money, I try to make it very clear that, it is a relationship, and it's based on trust. And, for me to support my customers best, I really need them to communicate good, bad, or indifferent.
Yep.
And when they don't communicate, especially bad news, then that's what really stresses the relationship. And you're putting your lender or factor at a disadvantage when you don't communicate transparently, because they're there to support your efforts, and the best way that they can work to help you is to kind of understand whatever the situation is. Businesses go through challenges, especially in this day and age. Most of our clients, they got into business because they're really good engineers, they're really good salespeople, but they may or may not be financial people. And so it's important to have kind of the trusted advisor board, your attorney, your banker, your finance person, your CPA, all available to support your efforts and understand whatever challenges you're experiencing.
Yeah, thank you, Jeff. The only thing I would add to that, and we're going to touch on this in just a little bit, the mistake that I find that a lot of borrowers make is that they haven't read their contract fully. They don't understand the covenants. They don't read them. They don't ask questions about them. And then they end up, busting through one, and they're very surprised that that was in their contract. Jason had touched on something, and wanted to kind of throw it out to you. The term sheet. When you issue a term sheet to a prospective borrower, what can that borrower expect in that term sheet?
I think Jason's right. I mean, it's a high level of how we would structure whatever requests they've come to us for. So you're going to expect to see, the amount of the funding, if it's collateral based, what sort of formulas that give you access to the amount being proposed. If it's a cash flow loan, what sort of term is the facility going to be amortized over? What's the maturity date of the facility? Specifically, what the payment requirements are. Is it principal and interest? Is it principal plus interest? Is it interest only? Lots of lines of credit are interest only. Is the bank going to require some sort of cleanup provision? In other words, you're going up and down on your line of credit, but for some length of time during the year, the bank may expect you to rest the facility down to zero. Is your business generating enough cash flow to go ahead and make that happen? Also understanding what the covenants are, and to Seth's point, making sure that you plug into your projections to make sure that whether you're being tested monthly or quarterly, provided you perform at 80% or better of your projections, will you be in compliance with the covenants that they're placing on you?
Yep. Now, and I'll say this about term sheets that we as an asset-based lender and a factor out there, that's very much similar to what we'll have in ours. We'll have in there, the advance rate, if it's factoring the discount rate, it's a loan, the loan percentage, whether or not there's a personal guarantee. We won't have a lot of the covenants in our term sheet, but we'll refer to them that they will be in the agreement. And a quick question to you, Jeff, are your term sheets, are they binding or non-binding?
Typically when you get a term sheet, it's not a commitment. So it basically means that the lender, they've reviewed the information you've provided, and based upon what they've looked at, they have, this is what they propose on how to address that situation. But generally, it is going to be contingent upon getting additional information, additional underwriting. In a lot of cases, there's a field exam to understand, how you manage your business, do your books and records, reconcile to the general ledger, how what do you sell, who do you sell it to, how do you bill, how is that invoice supported, when payments come in, how are those applied? So there's a lot of detail that goes beyond just the term sheet. Now, after that due diligence, we will from time to time issue an actual commitment letter.
Gotcha.
And, that commitment letter then would be binding.
Sure.
But at the term sheet level, no.
Yeah, and I'll tell you, for most asset-based lenders, there's a term sheet or an LOI that's issued, and then due diligence happens, and then you move straight to a purchase agreement.
Correct.
Yeah. So here's an interesting thing that happened. And so I will tell you that our term sheets are also non-binding, specifically state that. But here's a question to you, Jason. If you issue a term sheet and it doesn't specifically say that it's non-binding, does the borrower have recourse if you decide not to lend to them?
If it's not titled, non-binding letter of intent, or if it doesn't have that magic language at the end of it that says, this is not a commitment to lend, this is just general terms. If it doesn't have anything like that, then as a lender or a factor, as a finance company, you're putting yourself in jeopardy of opening that kind of claim. Absolutely, especially if then the deal doesn't matriculate and the borrower loses a job that they were hoping to get with your funding. So it's very important when you're sending out your initial LOI or your term sheet that it say that. It doesn't take much to simply say, our agreement will be embodied by a formal agreement to be signed later, and this is non-binding. Even though the letter of intent often will have a spot for the borrower to sign, simply saying they acknowledge that these are going to be the high level parameters. Really all they're signing in that situation is something that says, okay, we've got enough of a meeting of minds that we're going to take it to the next step, but nothing is binding on either one of us, except perhaps the due diligence fee that might have been paid by the borrower. But short answer to your question is yes, Seth. If it doesn't have something to the effect of that this is non-binding, then you're opening yourself up to that type of liability.
That happened to us very early on. Our term sheet did not specify, and one guy threatened to sue us. He didn't, but he threatened us. Let's go a little bit deeper. We've already started talking a little bit about covenants. Jason, would you mind kind of telling us the typical covenants that you see in lending agreements and factoring agreements?
Sure, you bet. Probably just to rattle off a few of the common ones, you're going to have, a minimum EBITDA requirement. You're going to have a tangible net worth requirement. You're going to have a fixed charge covenant requirement, a debt service coverage ratio as well. Those are all, financial metrics, right? And you can, as the borrower, as the prospective borrower, you can sort of pre-test and determine if you're going to be able to meet those historically as well as based on your projections. They might not always be addressed in the LOI or the term sheet. So you want to ask on the front end, if, to the degree that you can, get that information before you're getting much further into the deal. There are also covenants that control, or excuse me, that what we call the change in control covenant. It basically says, look, we're going to loan a bunch of money to this company, which is owned by the following people. And we're going all the way down to the heartbeats that are behind the organization that actually make it run. And it might be something as important as the namesake of the company, right? And it's very important for the lender that person remain in charge, or that there's not a huge change in the board of directors or a big change in the majority shareholders. And so you'll see some covenants that try to restrict that on the front end. Of course, those are negotiable as well. And as the prospective borrower, you want to ask yourself if it's reasonable looking down the road, does it accommodate or allow for some minority shareholders to come in, or for you, to kind of pass the torch and bring in new people to your company. Sometimes you'll see covenants that say that the loan will go into default if a guarantor dies. You've got covenants that you'll see that govern where the collateral has to be kept, or the chief executive office of the borrower has to be. Lots of things that are intended to increase the comfort level of the lender, and without micromanaging the company, that tell the lender this company is going to stay where it is or improve, and not have a drastic change and turn of events, not just from a financial perspective, but also from who's running the show and the nature of the business changing.
Right. Jeff, is there any covenants that y'all have in your agreements that are really kind of important covenants that Jason didn't mention?
No, I think I would echo what Jason said. I mean, we usually are looking at tangible net worth, fixed charge coverage, interest coverage. Sometimes we will drill down because we do some cash flow lending. Mm-hmm. We'll actually get into, definitions. For example, EBITDA, everybody knows that means earnings before interest, taxes, depreciation, and amortization. But we finance a lot of private equity types of acquisition financing. And when they're acquiring another company, there may be all kinds of synergies and savings, right, that they're expecting to accomplish through that combination. And so they'll get into, defining EBITDA and adding back certain things like run rate savings, personnel savings. Sure. Maybe the seller is sunsetting. Once they have their liquidity event, that salary that the principal once took is no longer there, so they want to have the ability to add it back. So we'll get into, I had one complicated transaction that we did for a technology company. And Jason, you'll appreciate this. The EBITDA definition was probably 2 full pages of very fine print.
I assume on your deals too, they have a financial reporting requirement to you?
Yes, we do. We typically are testing covenants on a monthly basis, but typically we're getting some sort of financial package every month that would include internally prepared financials, within 10 or 15 days of month end. We get collateral information, receivables, payables, inventory, equipment, all of that updated. And then, of course, at year end, we get a year-end financial statements, and usually within 120 days of year end, we're getting a full-fledged audited statement.
Yeah, I can tell you as an asset-based lender on our loans, we're getting a financial package every month. We may or may not require an audit. What's a little more challenging is on our factoring clients. We do require in the documentation financial reporting, and getting them to get that to us on a timely basis is a little bit of a challenge. I know other factors out there that don't require financial reporting because it's a factoring arrangement, but our deals are a little bit bigger, and we do require, and I do know some factors who do.
Mm-hmm. Yeah, absolutely.
Yeah. There's a question for you, Jeff. Why do lenders require guarantees?
I think, sometimes it's financial, where they want to know that the principal, the company, is providing some sort of backstop financially in the event additional capital needs to be contributed to the business. But more often than not, it's really a vote of confidence that if things do go sideways on a particular loan, that the principal taking out the loan will stand behind the business and assist the lender in resolving whatever issues they may be faced with.
Yeah, great answer. I can tell you that's what we look forward to. We want that owner to have a vested interest in making sure that we get as much of our money back as possible. Jason, a question for you. Can you define the difference between a validity guarantee and a personal guarantee?
You bet. So I'm sorry?
No, I was saying, can you define the difference between a validity guarantee and a personal guarantee for us?
You bet. So the personal guarantee, or even a corporate guarantee from a, either an individual that is, the owner of the company, or another company that's affiliated with the borrower, those guarantee agreements are traditionally unlimited guarantee agreements of guaranteeing payment. And no matter what happens, if the borrower can't pay, then the guarantor has to pay. The validity guarantee is sometimes known as either, a bad acts guarantee, a fraud guarantee. They all sort of do the same thing, which is the person, it's still a person in this case, that's signing that document says, since we're dealing with giving you financial information, we're giving you information about our account receivables, or we're selling you our accounts receivables. When we do that, I promise that I'm looking at that information and it's valid, it's true, it's correct. And if I'm aware of any kind of misrepresentations or fraud, or for any reason that if that stuff isn't correct, if we sell you dummy invoices, or if we give you fraudulent financial statements, then now I'm on the hook. But I'm not on the hook if we just simply can't pay because we're struggling as a business. Whereas the guarantor, the personal guarantee or corporate guarantee would be, the unlimited personal or corporate guarantee, they're not going to care, in that type of scenario, why non-payment was made. They're simply going to be having to pay. But the validity guarantee is limited, and it's just, to make sure that that person's on the hook only if they are aware of some fraud and didn't report it, or if they themselves, were complicit with giving bad information to the lender. And you typically are going to see those the validity guarantee is going to come into play usually when you have a company, a borrower that's private equity owned, or doesn't have, it's not a mom and pop operation, or it's not owned in large part by an individual, and the people running it may not even have an interest, stock in the company. But there's a CFO or a key employee that is in charge of that paperwork, and you just want them on the hook, but only for those limited reasons that I just described.
Great, that's a great definition. Jeff, do you guys take personal guarantees or validity guarantees on your deals?
So a lot of the transactions we're funding are private equity sponsored.
So probably none of them.
And so very rarely are we getting personal guarantees.
Gotcha.
If we're lending directly to an operating company, and the principal, is active, then generally we'll try to get personal guarantees from the 20% or greater shareholders. But more often than not, if there's a sponsor or a family office behind it, we don't get that. To Jason's point, that's where we will from time to time get what we call a validity of collateral guarantee, or something called a validity and support guarantee. And the support kind of comes in that if, God forbid, we're in a liquidation, they agree in advance to go ahead and assist with that process.
Got it. Jason, have you ever heard of a keep well agreement?
What? I'm sorry?
A keep well agreement?
No, that are you referring to?
I've seen one just very recently in a deal, and I'd never seen it before. I was just curious if you'd seen it.
No, that's a curveball. I haven't come across that. But there, while you're on that topic, there are a number of guarantees in between the validity and the unlimited guarantee. Some guarantee agreements will be limited as to dollar amount or percentage of loss that might be commensurate with the ownership interest that the personal guarantor has in the company. So you'll see that a lot of times, or you'll have guarantee agreements that burn off over a period of time. So there's kind of a range of things between those two that I've seen a lot.
Yeah, I'm glad you said that, because we've seen a lot in between, whether it be a limited guarantee or I've seen springing guarantees.
Yeah.
But we also we'll do some real estate transactions, and I've got a borrower right now that has a building, but they're going to add on to their existing building. And although we don't need any kind of guarantee for the existing facility and that debt, we do need a guarantee during the construction period. And, we're navigating whether that be provided by an affiliate entity or the individual personally.
So the affiliate entity so the keep well agreement.
I would invite any of our participants, if you have any questions for Jeff, myself, or Jason, please just put those questions in the chat room, and we will get right to them. Jeff,
so Seth,
what impact does fraud have on the lending industry?
It's huge, but I believe, Jason, you were going to speak to something. Just
sorry, you triggered. Yeah, you triggered my memory when you said about the affiliate stepping in, and I think that might be what the keep well agreement is referring to. Sometimes, if an affiliate or a subsidiary that you may or may not have underwritten needs to access the same capital and the money that you have lent to the borrower. That could be the affiliate or a parent. Sometimes that type of agreement, that may be what they're referring to, Seth, where a subsidiary or an affiliate wants to access the money that you've given to a borrower. Sorry, just came to me.
Yeah, no, absolutely. Just speaking to that, if there is an affiliate or a private equity sponsor, a lot of times we will underwrite what sort of capital is available to the operating company in the event it's needed. And so as part of the cure provisions under covenant breaches, there may be some sort of ability to call on that capital. We want to make sure that that capital does, in fact, is available when needed.
Got it. Do you allow your customers, if there's a covenant default, let's say, for instance, they didn't meet their net income requirement or their EBITDA requirement, that a capital infusion will cure that default?
Yeah, we're usually getting quarterly covenant compliance certificates, and more often than not, I have one right now where they're not in default at the moment, but their projections show they will be. And so we're beginning to have those discussions as to how that cure could be. Is it going to be an equity cure? And if it is an equity cure, and then once they've reached that level where they're consistently compliant, then we give the borrower the ability to pull it back.
Gotcha. Very good. Okay, circling back to fraud.
Yes.
How big of an issue do you think that is in the lending industry right now?
I mean, I think it's always been an issue, especially in volatile economic environments. There's a saying that, all the borrowers are honest until they're backed into the wrong quarter.
Right.
And, people do tend to, sometimes borrowers will get backed into a corner and they do things that they shouldn't do, rather than communicate with their lender as to how to resolve whatever challenge they're faced with.
Yeah.
So it's obviously something that's always top of mind.
We've seen that too. The most common one is misdirection of funds, where funds are supposed to be going into a lockbox or coming directly to the factor. They get into a jam and they'll call up their customers and say, send the payment here instead of there.
Right.
And it's usually because they're having problems, and instead of picking up the phone and calling us and trying to get a stretch or something, they'll do that thinking that they can fix it later on, and they never can. Correct. Yeah. Jason, have you experienced a lot of situations where you've had to go after people because of fraud?
Yes. My view is a little bit jaded, though, because I that's when I get called a lot is, of course, after we book a deal, the lenders aren't calling me to say everything is going fine. I'll get, the phone call that someone stole money. And I've seen an increase in fraud events. And I can't really explain it other than, I thought that maybe the access to PPP money might have kept people from being backed in a corner, but I don't think it did that. And I think, you're gonna always have it. It's always there. It's always been there. But it's definitely still with us, and there's new ways of going about it, especially in the asset-based lending world. It's not too difficult to manufacture invoices or account receivable aging reports. I've seen some of the technology that can help prevent that, because you can, access different systems, bank systems or vendor portals and things like that, but it's still out there. I've even seen more collusion between account debtors and borrowers, even, believe it or not. And then there's, always an increase in identity theft, which is easy to overcome, I think, with respect to, just knowing your customer. And, but some of those internet lenders, I would call them, where it's all online, are not, they're particularly vulnerable to what I'm calling identity theft, but it's a fake borrower who's able to get money and get the loan and then be gone. And especially some of the ACH lenders and MCA lenders out there, are susceptible to that for sure.
Great. I see that Mark Tiggeloven has joined us. Mark, we're talking about fraud. What impact are you seeing right now? Are you seeing fraud up or not as bad right now?
I think Mark's audio is messed up. I don't know if.
Yeah, I was hearing the same thing.
You were okay, Mark.
Mark.
I think your audio is not working. We can hear you, but you sound like you're talking a mile a minute.
Yeah, that's not working.
Can you hear me okay?
Yes.
Yeah,
You can.
hear
Okay.
fine, Jason.
How's this?
Oh,
Yeah,
better.
now we can hear you.
Perfect.
Perfect.
Okay. All right. I guess somehow maybe my camera microphone is not working. And my apologies to everybody. I started to
Would you
say
mind just going through that again, Mark?
Yes, I will. So on the fraud, we haven't really seen any large fraud here recently. Maybe the last year and a half, we have definitely had some. But I think that it's a little bit more of a nuance, I believe, right now, where if borrowers have a little bit of a financial stress or working capital stress, that they might maybe on the borrowing base delay application of payments in their system, or maybe bill a little sooner to create that availability. And it's really just kind of a timing matter for them. And so they think they can probably fly underneath the radar for a while, and that's on the ABL side. On the factoring side, we obviously, when we're buying invoices, is it delivered? Have they earned everything that they're invoicing for? That's we can't verify every invoice, so you do take you have to trust your customer to some degree. So I think that's where you see some subtle nuances. Is it fraud? Yeah, technically yes, but we all work with our clients, and so I think that's what we see a little bit of more than anything right now.
Gotcha. Very good. Mark, I'm really glad you joined us. I wanted to throw a previous question out to you just to get your input. We got it from pretty much everybody else. With interest rates going up and the anticipation that they'll continue to go up, how do you kind of see the lending landscape over the next year to year and a half?
Well, I think the access to capital will be there. Obviously, with the higher pricing, it becomes a matter of whether or not the business can afford the financing from a debt service standpoint. On the landscape front, we have the regulated lenders, and then we have the non-regulated lenders. I think the regulated lenders are probably going to see maybe a little bit of a harder time when you start restating PPP loans, as that was a kind of a one-shot income producer for these businesses. So from an underwriting standpoint, we see that those sometimes get backed out. So from those They might be harder to qualify. The non-regulated financing companies, they might have an easier time with those deals, but they'll be higher priced. So companies coming off of a 1 or 2 bad years, and it's competitive market as well. So we probably see some contraction in the margins for the borrowers.
Yep, very good. Well, we don't have any questions from our participants, and I've run out of questions, so I would like to thank all of our panelists. It was very enjoyable, and thank you to our participants. Y'all have a nice day.
Thank you.